Welcome to vTalkInsight, Market Drivers Daily for February 5th, 2026. AI volatility, real economy growth stories, and a powerful rotation under the surface are all colliding today, reshaping how risk is priced across sectors and regions. Let us start with the AI complex, where valuations, capex, and disruption risk are pulling the market in very different directions. AI remains the central growth narrative, but the way markets are expressing it is changing fast. After a long run of broad enthusiasm, stretch valuations in AI and semiconductor names are colliding with rising doubts over how quickly innovation turns into cash flows, and that mix is fueling sharp repricing and volatility. Compared with earlier this week, when hardware and physical infrastructure were already leading AI returns while software came under pressure, that divergence has only intensified. Recent advances in automation tools, including Anthropic's latest legal and productivity agents, have triggered a series of air pockets in software, data platforms, and financial services. Global software indices have seen hundreds of billions wiped off their value, with some SaaS and services stocks down 25 to 30% this year as investors reassess which business models might be hollowed out by AI. Yet at the same time, core AI infrastructure names and chip suppliers are still attracting capital, underlining a rotation within the theme rather than a wholesale retreat. The clearest signal of that rotation is on the capex side. Alphabet has laid out an aggressive spending path, with cloud and AI infrastructure guidance far above prior expectations, and investors are already extrapolating that into stronger demand for key hardware suppliers, such as NVIDIA and Broadcom. Oracle's record demand for its $25 billion bond deal tied to AI infrastructure and strong share price reactions at Supermicro after upbeat outlooks reinforce the sense that the capital-heavy part of the stack is where conviction remains highest. Beneath the surface, views on AI's payback profile are extremely polarized. On one side, enterprise adoption is moving from pilots to production, with many firms reporting real productivity gains, especially in coding, data operations, and automating administrative tasks. Surveys suggesting that over 80% of companies expect to have live AI products by year and support the idea that tangible benefits could show up in earnings as soon as 2026, particularly for enablers like chips, power infrastructure, and vertically integrated cloud platforms. On the other side, there's growing concern that markets may be getting ahead of fundamentals in parts of AI. Previous software valuations north of 30 times revenue, secondary transactions valuing private AI firms in the hundreds of billions, and compressed multiples that still look rich are all being cited as signs of potential bubble risk. There are also hard physical constraints emerging. The United States is expected to see electricity demand rise 20 to 30% over a few years, and permitting, grid connections, and public resistance to higher utility bills could slow the pace of data center build-out. For portfolios, the key watch points are how upcoming big tech earnings translate massive capex into monetization, whether semiconductors can avoid a classic boom-bust pattern, and how far the market continues to reward infrastructure and power plays over more speculative software exposure. With that AI backdrop in mind, the next question is how much of the broader growth story now sits outside the traditional tech complex. The growth narrative is no longer confined to a handful of mega-cap platforms. Across regions and sectors, the picture today is of a global economy running above the gloomier expectations of late last year, even if not every indicator lines up cleanly. In the United States, forecasts cluster around mid-2% GDP growth for 2024, supported by stimulative fiscal policy, still accommodative financial conditions, and early AI-driven productivity gains. AI's role in that macro story is subtle. On its own, automation is expected to be disinflationary by lowering unit costs in areas like programming, compliance, and document handling. Yet combined with fiscal expansion and robust demand, it could still deliver strong real growth with only moderate, sticky inflation. Some observers argue that structural productivity in the United States already looks stronger than in the 2010s, but also warn that official statistics may be temporarily flattered by heavy AI investment and labor market distortions, raising questions about how durable current gains will prove. At the micro level, growth is increasingly coming from diversified, real economy franchises. In beverages, premium and alcohol-free segments are expanding rapidly, and Carlsberg now generates more than half its business from soft drinks and premium or alcohol-free beer, with India delivering a decade of roughly 10% compound revenue growth, and even an IPO being considered for that operation. In healthcare, the obesity and type 2 diabetes markets remain deeply underpenetrated, and Eli Lilly is flagging sustained double-digit growth potential out to 2026, supported by strong early demand for its oral GLP-1 pill and a vast global patient pool. Financials and infrastructure also feature prominently in the growth mix. Euroclear has reported record 43 trillion euros of assets under custody and a 20% jump in settlement turnover, underscoring vibrant activity across bonds and ETFs, while Citigroup's restructuring into clearer business lines has already delivered 7% revenue growth during the transition. Wealth and retail platforms are expanding as well. UBS has laid out ambitious targets for net new assets over the next few years, and Charles Schwab is adding around 1 million new accounts a quarter, with a notably younger client base that extends the lifetime value of those flows. This upbeat picture is not uniform, and that nuance matters for positioning. Some U.S. consumer discretionary names are not fully confirming the stimulus-led recovery narrative, and parts of the pharmaceutical sector face profit pressure from generic competition and political action on prices, even as obesity and diabetes drugs boom. China is expected to grow above consensus this year thanks to stimulus and easing deflation, but doubts remain over how long that momentum can be sustained, while Japan's improved nominal growth is accompanied by rising yields. When set against already elevated valuations in some growth franchises, this combination suggests that earnings delivery and pricing power will be crucial, especially if markets continue to rotate away from a narrow tech leadership. That brings us to the third strand of today's story: how these cross-currents are driving deeper market divergence beneath relatively calm index levels. Headline indices look contained, but under the surface markets are anything but quiet. The S&P 500 has been trading in a broad range, even as volatility indicators tick higher, because sector rotations and style shifts are offsetting each other. High trading volumes and wide intraday swings around earnings season point to active repositioning, rather than a clear top-down trend. One of the most striking developments is the rotation away from expensive, long-duration growth into value, quality, and cyclicals. Energy, materials, real estate, and healthcare are outperforming, while big tech and communication services have lagged, and a sharp factor shift has seen momentum strategies sell off as investors focus more on cash-rich, fundamentally solid companies. Value indices, including the Russell 1000 value, are outpacing growth benchmarks, helped by sectors that benefit from a weaker dollar and from rising physical demand, such as the expected 20 to 30% increase in U.S. energy consumption over the next few years. Within technology, dispersion is even more dramatic. There is now roughly a 60% performance gap over 6 months between semiconductors and software, with hardware and AI infrastructure names rallying while many software and services stocks suffer deep drawdowns. That creates both concentration risk and an asymmetry. If the current euphoria in semis were to fade, the structural linkages between chips and the rest of tech could transmit downside quickly into broader equity indices. Size and geography add further layers to the divergence. The Russell 2000 is up nearly 7% year-to-date and continues to outperform large-cap tech, helped by tight credit spreads, easing lending standards, and sensitivity to domestic U.S. growth. At the same time, investors are trimming U.S. equity overweights and increasing exposure to Europe and Asia, while currencies like the Australian and New Zealand dollars and Brazil's real are preferred over fiscally constrained European peers. Japan stands out as well, with equities in banks and real estate posting new highs despite rising government bond yields, as local investors position for a reflationary regime shift. Not all divergence points to fragility. Some of it reflects healthier breadth. Most S&P names are in positive territory, even as a handful of large-cap tech stocks drag on the index. And earnings acceleration is becoming more visible among non-mega-cap technology and traditional growth sectors like healthcare and select retailers. However, there are clear fault lines. Software-heavy indices have endured deep corrections despite strong balance sheets, and individual names show stark contrasts, such as Eli Lilly's robust growth outlook versus peers facing revenue declines. Key watch points now include whether small caps can hold their leadership if rates stay elevated, how long the semis versus software gap persists, and whether rotations into value, energy, and quality continue to strengthen or reverse. Together with the AI and macro stories we discussed earlier, these divergences will shape the opportunity set far more than headline index moves over the coming months. To sum up, AI remains the dominant structural force, but markets are shifting from broad enthusiasm to a sharper focus on capital-intensive infrastructure, realistic monetization timelines, and the hard physical limits of power and data center capacity. Growth is broadening beyond mega-cap tech into healthcare, energy, financials, and select emerging markets, even as questions linger over how sustainable current productivity gains and China's stimulus-driven momentum will be. At the same time, sector, style, and regional divergence is deepening, with value, quality, and small caps gaining ground, while parts of software and big tech re-rate lower, putting a premium on earnings resilience and balance sheet strength rather than simple index beta. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.